Test 1, 2, 3, 4. 1, 2, 3, 4.
Good morning.
Morning.
There's Patrick. I can't. My volume's low. There we go. Hey, Patrick, is that better?
I can hear you perfect.
What are you having for breakfast, Patrick?
A donut.
Good morning.
Donut
Morning.
and soda. You can't beat that. You won't be able to go to that Gators or whatever it is up there for lunch.
I'm not. I'm in Miami.
Yeah. That's what I'm saying. We won't get to go to Gators or whatever it is for lunch in Palatka.
Yeah, that's too bad, isn't it? So, Patrick, I'm going to ask you a question. If this plan is up for the fiscal year, we have just a couple more weeks, but if they're up 22%, 23%, that's going to have an outstanding impact on your stuff.
Yeah, I can look at that. You want to use 20% just to be safe?
Yeah. Why not? There's Dwayne.
I'm here. Hi.
Hey, how you doing?
Good.
Can you see my picture?
No.
I see you. For some reason I'm not up.
Oh, I see you now.
Okay, where's Jill?
Good question. It's 4 after.
Gentlemen, it's 10:04. Is anybody else online for the meeting?
When I saw somebody else earlier. Are you gonna try to get a hold of Joe?
I thought the meeting was 10:30 originally.
Really?
Yeah, it seems like I got a 10:30 email a long time ago. Then this morning I was looking and it said 10.
Well, but this was sent out on the 8th for the 10 a.m.
Isn't it usually at 10:30?
No,
No.
that doesn't mean you're not correct. You may be correct. I'll try to call her right now.
Yeah, I don't have a cell phone. I just have the regular line.
Good morning. Can you guys hear us?
Yes.
Hey,
Right now, we're waiting on Chairman Myers to join us. Still no word from him. If not, we're just going to proceed as usual.
perfect.
Thank you all for your patience. How are y'all doing today?
Good.
Good.
Is the att- is the-
Make sure that your microphones are,
Yes, I'm here.
Oh, good.
and I guess we'll start the meeting. The first thing we're going to have to do is decide who's going to run the meeting. So, okay, roll call. Brent is missing. Art Leary,
Here.
Alec Dowell,
Present.
Justin Campbell,
Present.
Mark Linnity. Okay, so we do have a quorum of 3 here.
That's good.
Yes, we need 3. We have 3. Are you okay with Justin Campbell appearing via Zoom?
Yes, ma'am.
Okay.
I'm here.
All right.
So the next, after roll call, is to elect someone to chair the meeting. If you would decide among yourselves and somebody make a motion.
Second.
Okay. All in favor?
Aye.
Aye.
All right, so Alec is going to run this meeting. Commissioner Campbell, did you vote?
I did.
Aye.
Yes.
Thank you. So it was a unanimous vote, and we can move on to approval of the minutes.
All right. Do we have a chance to look over the minutes? All right.
Second.
Motion made by Mr. Leary and Art. All in favor, say aye.
Aye.
All right, next up item on the agenda is the review suggestion for experience study by Patrick Donlin and Foster.
Yeah, can you guys hear me okay?
Yes, sir.
Yeah, it's been 5 years since you guys did your last experience study, and the actuarial standards, and then the FGFOA, and lots of organizations and the auditors recommend that you do experience studies at least once every 5 years, where you look at your actual experience as far as retirement rates, termination rates, salary increases, all those types of things, and the investment returns. And then you say, okay, based on that experience, maybe we should change our assumptions going forward. And so I had recommended that you guys do a study, another study, because it's been 5 years. And you guys kind of wanted to wait because of the salary study that's being done by the city. I think that that's still not quite done. But I do know that it looks to me like it's going to be kind of a temporary issue where they're trying to catch up to the new minimum wage or catch up to other salaries of cities around. But I don't think it's going to affect the expected individual salary increases, for the next 30 years. Because we're looking at long-term, not just the 1 year, kind of like with investment return. We look at what we expect for the long term, not just for the 1 year. So I just wanted to open that back up to the board to see what they thought.
Patrick,
it's
what does that study cost us?
Well, our minimum fee is 7,500, so that's what we would charge you. And like I said, you only have to do it once every 5 years. So it's, that's about $1,500 a year when you spread it out.
And you're saying the salary study that the city's doing, whatever findings they come up with, it's not really going to impact what the study might tell us?
Exactly. I mean, what we're looking at is, 10 years from now, what do we expect people to get for salary increases? If they give big salary increases for the next 2 years, then, the city's costs are going to go up a little bit in the valuation report because of the experience for that year or two. But it's not going to change what we think individual salary increases are going to be going forward. Does that make sense?
Yeah, yep. Thank you.
And if you guys approved it today, then I could present it at your December meeting, and then any changes you make, I could make in the GASB and the valuation report that we do, in January and March.
Yes, sir. Being that we're in the final stages here of this year's salary study, it should be coming to a close in the next several weeks. And the absence of Chairman Myers today, I believe we should just postpone it one more meeting and then re-adjourn with this topic come December. By then, we'll have all the data that we collected from the salary study from the city, and we'll have a better foundation of where we stand on that front. So I think we'll have more information for you then, and I think it'd be more beneficial just to wait. I understand the pertinency of the study, so I just think we should push it back just because of the
Yeah,
current
that's fine. That's fine.
state.
If you do it that way and you approve it in December, then I'll do it really at the same time as the valuation report in March, and then we can see the actual experience for another year, and we'll see the results of the good investment return that Burgess is getting you this year. So that's fine. We can do it that way.
Yes, sir. Let's go ahead and you want to make a motion for that?
That's your motion.
Second.
All in favor, aye? Aye. All right.
All right, I'll stick around in the background here in case anything comes up.
Thank you, Patrick. We appreciate
Sure.
your time. Next line item on the agenda is the Capital City Trust. Dwayne Madron.
Good morning.
Good morning, sir.
If you could please scroll down to the investment policy review page. This is as of August 27th. So just a peek at how we're positioned. Still overweight large US companies, stocks, at the expense of being underweight international equities because of the issues in China. China is cracking down on some of their larger, more successful companies like Alibaba, Tencent, JD.com. And they've also had problems recently, yesterday, with the real estate market. In addition to that, the S&P 500 index already has several international companies in it. So we have plenty of international exposure to companies that are denominated in the US dollar, which is always a good currency to be in. So nevertheless, continuing on down the page, small cap and mid cap are neutral. Don't have any strong biases either way for those two segments of the domestic equity asset class. Underweight Reit, which year to date has been an average decision, as of large cap equities and REITs have performed about the same. Last quarter, it hurt being underweight to REITs. I still prefer large US companies like Microsoft and Apple, and especially Google. Infrastructure is underweight, of course, at the expense of being overweight large US. If you could scroll down a little bit more, please, you'll see that convertible bonds are underweight. And then fixed income is a little bit underweight. So that's mainly because large US companies are overweight. Just to give you a little bit of flavor, in the second quarter, which is the quarter that we're in measuring, Google was up 65%. Target was up about 40%. And Microsoft was up about 30%. That's just goes to show you that earnings are strong. Investors still believe in large US companies. Consumers are still spending, especially because interest rates came down. That helped stocks, and because people were getting vaccinated at a good rate, not the rate we want, but they're still getting vaccinated. That gave the market confidence. People started to travel, move around. There's light at the end of the tunnel. And really, stocks don't have a lot of competition from bonds because yields are so low. So it has been a good quarter. If you continue to scroll down, please, to the performance page, we can look at returns. So for the second quarter, which is ending June, the total combined equity that we manage was up 6.63%. The stock part, equities, was up 7.3%, slightly behind the S&P 500 because of the drag down from international. Bonds were up 3.5%. That includes the high yield and the convertible bonds. And that's because interest rates fell a little bit. And real estate's up a big 11.67%, as interest rates make it a very, very favorable climate for real estate investing. So year to date, through the end of June, 29.9% outstanding return. And that is mainly because of the Fed stimulus, which keeps interest rates low, which pushes money into the stock market, which has caused stocks to be a little bit expensive. Nevertheless, as long as rates remain low and stocks don't have a lot of competition, you'll see stocks continue to go up. So equities were up year to date 32.8%, outperforming the S&P 500. The bond portion, which are convertibles and high yield, they tend to have an equity-like component to them, and they're up 18.5%. Real estate 32.5%. So it's been outstanding returns, returns that you don't see too often, and that's because there's a lot of liquidity out there caused by the Federal Reserve stimulus and the reopening of the economy. So if there's no questions on returns, we can scroll down.
Dwayne,
Yes.
this is Burgess. Good morning.
Yeah.
But before you move on this page, I just wanted to help everyone understand what they're looking at here. the convertible bond that you're talking about,
Yes.
where are they in the top left corner?
They are in the taxable bonds.
Okay, so I mentioned this to you before. I just wanted you to clarify this. The state deems the convertible bonds as equities. We can't keep, you got to move them out of the taxable bond category. They're not considered, if you read the investment policy again, they're considered equity. Okay, I mean, that's what
Okay.
they are.
Yeah.
So the division of insurance that regulates the insurance pools around the state is they deem convertible bonds as bonds. But for purposes of pension plans, we have to, I just want you to be aware of that. So if you look at the total at the top, the 7 million, I take it does not include the fixed income managed by Sawgrass.
That's correct.
Okay. Just wanted to clarify for the members of the board.
And so, and Burgess, also that taxable bond number is the high yield bonds.
Yeah, that's fine.
So do you, and I'll try to accommodate what you requested. Do you also want the high yield bonds classified as equity?
No, if you read the investment policy, high yield bonds are bonds.
Okay.
Thanks. Keep going. I'm sorry.
Yep. So, so that's as of June. If we page down to the next performance, I happen to have July. So here we have July year to date, we're up 30.8. So that improved about 1% in 1 month. You know, equities are up 33.79, taxable bonds 18.2. So I guess after July, we saw the market start to slow down a bit because it was getting a little bit expensive. And the Delta variant was beginning to scare the market a little bit. And so since mid-August, I've seen the market slow down to a crawl and volatility slow down to a crawl until yesterday when there's a hiccup in China. But it's been calm the last couple months. It's almost kind of eerie. So I wouldn't be surprised if we had another correction before December, but I use that opportunity to buy more equities. In fact, I may be buying this week because we had a 2% pullback yesterday, and I have some extra cash. So if you want to,
Dwayne, let me ask you another question, if I may. I'm certain, I suspect that the members of the board in the back of their mind are wondering how you're going to prepare the plan for a downturn. Is there anything that you would like to do preemptively in anticipation of further declines in the market? How do you plan to kind of sail through this volatile period?
well, I guess I have, when cash builds up to greater than 5%, I have two choices. I can move the cash to bonds, which are in a precarious situation because interest rates are creeping up and supposed to go up. Or I can sit on cash and wait till the market pulls back and look for the asset class that is most attractive at that moment. And so yesterday, everything sold off approximately the same. And I prefer to put money to work in the S&P 500 index because the large cap companies tend to perform in a slower moving economy, and that's where we're headed. The reopening has happened. The GDP growth has been outstanding, but that's not going to always be here. And when we come back down to earth, it'll be companies like Berkshire Hathaway and Johnson & Johnson and Walmart, and Target and Microsoft and Google that keep us moving. So that's how I would do it. And we are now about 3% below the cap on equities. So I have a little bit of room to buy, not much. So I look at the cap and I look at the 3 to 4% under the cap is where I would buy.
So the CIT piece at Sawgrass, you see that big picture when you're looking at the total equity percent allocation, right?
Yes, I do.
Oh,
And
good.
I certainly do.
Good.
But with interest rates, all the forecasts you look at have us going up to maybe 2% on the 10-year by December, which is not good for bonds. However, if you look at many of the larger companies in the S&P 500, I can name several right now that are undervalued. Even though the market has gone up, they're still upside.
Okay, thank you, Dwayne.
Yep. So that's as of July. If you scroll down to the next section, it's asset allocation. It simply talks about of September 8th, the market value of the account, which is 9,931,637. 58% is in equity and 32% is in fixed income. So it's a moderate growth portfolio. It's not aggressive. And so that's just a snapshot. The rest of the account is just a listing of the funds that we own. And I don't specifically need to go into that because I covered it in the policy review. So
Dwayne, let me just clarify on this slide. We talked about this a minute ago. If you were to move the converts back over to the equity,
yes,
that would change that 58% would go up, right?
yes,
Okay.
and I will do that.
All right. Thank you.
So that concludes my comments. Finishing out the fiscal year looks to be strong. The low interest rate environment has been good for pension plans and for stocks because many pension plans are overweight stocks. And so it's been a wise decision to stay the course. That's all I have to say.
Thank you, Dwayne. All right. Yeah, we're gonna make a motion to accept the report. Do you guys have any questions? All in favor, say aye. Aye.
Aye.
All right. The next item up on the agenda is the BCA report by Burgess Chambers.
All right. Good morning. There it is. Great to be here today. I'm in Miami. I'm having some surgery on my hand tomorrow. So I had to be ready for that first thing in the morning. So that's why I didn't come up to Palatka. If you go to page 1, and let's see, there you go. Thank you. Can you all see that? There are 4 graphs there, and those graphs represent different time periods, yellow being the longest, 40 years, and the blue being 10 years, represent different asset allocation strategies that have accomplished different rates of return over time. And you can see that over the last 40 years, an asset allocation that's similar to what you're doing, that 65-35 blend, earns something in the neighborhood of a little over 10% per year. And that's going back 40 years. The blue one, you can see that the returns have been higher for that 30-70, which is pretty close to what you're doing per year. And that's based on the models that we developed. And this, I'm kind of showing you the secret sauce of what we do. We play around with these different models to achieve a strategic model. Okay. And I think Dwayne's done a good job. He has used the tools that are available in the investment policy statement, that is to move in and out of large cap or REITs or infrastructure where he sees appropriate from a tactical standpoint in order to keep your program on track Historically, it was an 8% target return, and now, it's moved down towards 7.5%. Let's go to the next slide, please. In fact, let's just go to page 4. There's a little bit of the difference between our reports. Really, it has to do with where the convertible bonds were identified, but anyway, this what you're looking at now is the way we've been doing it for quite some time. And you can see at the top, there's the 65-35 model. That's the program, and it's worked out well for you. The quarter return of 500,000, it was ahead, and Dwayne has maintained a significant overweight to large cap. That's the S&P 500 index, and that's been the primary reason. And even for the 1 year, at 2.1 million or 27% net, the overweight to large cap has been a major factor. The 3 and 5 year rankings are very impressive given the simplicity of the program and the fact that there's a lot of indexing here. These rankings are important to understand because you're being compared to pension plans all over the United States, from Texas to New Jersey to Wyoming, everywhere. So the fact that you're pretty close to the top, at least the top third or the top quarter, means you're doing something right, and you're outperforming the vast majority of your peers. The 10-year number is also there. You've earned 6.2 million, averaging a little over 8% per year. I went to New York a couple weeks ago before the 20th anniversary of 9/11. I was up there that weekend. I did visit Cohen and Steers, and it was a very interesting meeting. It's the first meeting they've had with a consultant since March of 2020. So I didn't have any problem going up there. I've had my vaccinations and so forth. This program is with Cohen and Steers is designed to do better and better with the opening up of airports around the world, transportation as it picks up with rails, with toll roads, the 5G build out of cell towers. All of that is happening, and that's helping drive their performance, as well as their ownership of small FBOs, fixed base operator, that sell fuel to general aviation. We talked about the convertible bonds a little bit already. When you look at these returns, they don't look anything like bonds. When you have 19.7% return annualized for 5 years, that's because of the equity optionality built into the programs. The Euro-Pacific continues to outpace its benchmark by a large margin. The REIT, which has done well for you recently with the recovery since the early part of last year. And of course, fixed income continues to be a somewhat of a drag, relatively speaking, but you remember it's an important liquidity place. That is when, as Dwayne talked about it, if we have another reset down pricing of equities in the future, he's going to look at the fixed income to balance back into buying more equities. And that's why it's there. Let's go to the next couple of slides. Go to page 7, please. And this looks at the math going back 10 years, a little bit a different way than you saw from Dwayne. There's the 6,056,000 was the value of the plan 10 years ago. And there's 6.2 million was what was earned during the last 10 years. You're right around 10% right now, 10 million right now. And if you look at the fiscal year to date number at 19.8%, let's just say you're right around 19%. fiscal year to date with the sell-off yesterday. It's back a little bit today. But we've got another couple of weeks, but it's quite possible that you'll get a 20% return for your fiscal year. And that'll make Patrick happy. Patrick, you still on the phone?
I'm here, yep.
Let's go to page 18 and put that 20% in perspective. This goes back to 2005 on the right, going from right to left. And if we do, if you're able to pull out, if Dwayne's able to make the magic happen for this year at 20, that'll be the best performance in a long time. I mean, the last time we had a number that close was in 2012. And Patrick, you use a 5-year or 4-year smooth here?
Well, we actually just changed last year to a 5-year smooth. Maybe I wish we wouldn't have, but this will be good because the good return that we're getting this year will help us for all of the next 5 years. And
Well,
so
yeah.
Burgess asked me to look at, the estimated impact that would have. And like your GASB funded ratio in the back of the report, the accounting, you had a net pension liability of 2.9 million. Well, if we get a 20% return, that's going to be a little over $1 million excess return above what we expect. So your net pension liability should go from about 3 million to about 2 million. So your funded ratio would go from about 74% to about 83% on the accounting side of it. As far as the funding requirements, because we use that 5-year smoothing, your funding requirements will go down about 1.6% of payroll with that good return, because we're only recognizing, 1/5 of it each year for the next 5 years. But that'll give us a nice cushion. If there is any kind of market correction or pullback, it won't bother our funding requirements because of our strong return this year.
well, thank you, Patrick.
Sure.
So, Patrick, we're looking at this slide, 2007 or 2016 is going to drop off, right?
Well, actually, last year, we actually reset.
Okay,
We set the market value equal to the actuarial value equal to market value. And we're just starting a new 5-year smoothing with this year. So those prior years don't really affect us.
okay. Well, that's all I really have to present today. Are there any questions for me?
No, sir, I don't believe so. Thank you very much, Mr. Burgess. We hope you have a
Thank
speedy recovery with your surgery.
Thank you.
Yeah.
Thank you.
Motion made by Mr. Leary or Mr. Leonard to accept the report.
Second.
All in favor, say aye.
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 Next up on the agenda, Klausner, Kaufman, Jensen, Levinson.
Hey, good morning, everyone. For those of you that I haven't met yet, my name is Anna Klausner Parrish. I just have a few quick things on the agenda to go over with you. You should all have the summary plan description, the draft for the 2021 version. Nothing major, mostly housekeeping issues to make it more consistent. We added in that there was a new ordinance in 2020, made a few of the provisions more gender neutral, saying he or she or they, capitalizations, punctuation, nothing major. If there are any issues or changes, I am happy to make those. Otherwise, please let me know if there are any questions about any of the changes.
Anna, could you explain why this is being done now?
She's got questions about like. what she-
Anna?
for the future, what the work it does for that stuff.
Yes.
She's very pleased with the performance.
Okay,
If you want to come in and
Yeah.
talk.
I will.
Thank you.
Anna, is there any reason why this is being done right now?
I believe it's been, and I apologize if this is repetitive. I believe it's been 2 years since you've last had your SPD at December 2019. It is required to be done every 2 years. There needs to be an update. So that's why.
Thank you. Is there any pertinent changes really that were made that we should be made aware of here today?
Sorry, everyone, I'm having some internet issues, but I think that I'm back on.
Can you still hear us?
Yes, can you hear me?
Yes, ma'am. Is there any pertinent changes that were made today that would need to be brought to our attention?
No, like I said, mostly housekeeping issues. There were 2 sections at the end that were added, ex-spouses as beneficiary or joint pensioner. Just important information that could be applicable to a lot of members. Just trying to give them as much information as clearly as possible, but no major changes.
Okay. In reference to the ex-spouses, what exactly does that entail?
Sure. So it says that the Florida legislature adopted a section of the Florida statute which nullifies a designation of an ex-spouse as a beneficiary or joint pensioner or joint annuitant. This went into effect July 1st, 2021. So essentially, once you become divorced, your ex-spouse is no longer going to be your beneficiary. So if you would like them to still be a beneficiary, once they are an ex-spouse, they'll have to make that designation after they're divorced. So if they don't make that designation, it's automatically going to be null. If that makes sense.
Yes, ma'am. Thank you very much.
No problem.
Other than that line item there, is there really, I'm just kind of trying to comb through it real quick. Is there really?
No, of course. Nothing
really-
major.
Okay. All right. Well, does anybody on the board have any questions for Miss Anna?
And I was just curious,
Sure.
just looking at how is that something, is this mandated? I've noticed all the his and her and all the
That is
gender
not
references were
sure.
taken out.
That is not mandated. That is just something we're doing across the board. But if there's anything specific that you want me to change back to how it was before, or if there's, additional wording that you would prefer, I'm happy to do that. But no, that is not a mandated change.
Okay, that's just something that makes it easier for you guys.
Inclusive.
I believe we lost Miss
But
Anna
this
again.
change is being made.
Okay.
Can
thank
you hear me?
Yes, ma'am. Now we can.
Okay. Okay, so if there are no questions, then you could, you could make a motion to adopt the changes, and I will provide you with a clean copy.
Sounds good.
Second.
All in favor, say aye.
Aye.
All right. Motion made to accept the changes of the Klausner, Kaufman, and Jensen report. Next up on the line items of the agenda is the quarterly expenditure budget.
Actually, Anna has a couple more documents.
Yes, just quickly, I just wanted to bring these to your attention.
All right.
The federal, state, and local death benefits memo. This is a memo that we have put together and have recently updated, which outlines the federal death benefits that can be awarded to public safety officers in certain situations. Unfortunately, I am currently in the process of about 5 or 6 of these. Hopefully that is going to slow down. This does just go over, it is a lump sum benefit, and the amount changes depending on the type of death of the police officer or firefighter, It goes over funeral benefits, health insurance, educational benefits for surviving spouses and beneficiaries, workers' comp benefits, etc. Just a good resource to have. I hope that you don't have to use it, but if something comes up and you do need assistance, I'm happy to file the application on your behalf.
Thank you.
And just last, in that same venue, there is a COVID, there we go, a COVID benefits memo. You can see that on August 14th of last year, they signed the Safeguarding America's First Responders Act of 2020 into law. It provides a presumptive line of duty death and disability benefits to qualifying public safety officers. Under this act, if there's an officer or firefighter who dies or becomes permanently and totally disabled, they're entitled to a presumption that COVID was work-related. In order to qualify for those benefits, they have to meet the 4 pillars on here. No medical evidence that it wasn't directly caused by something other than COVID. They have to be engaged in the line of duty between January 1 of 2020 and December 1 of this year. They must have received a COVID diagnosis during a 45-day period between their last day of duty, and evidence indicates that they did have COVID or complications thereof at the time of death. Just to make you aware, there is currently a bill pending that would require vaccination in order to receive death benefits from COVID. Like I said, it's pending, and we'll keep you up to date on that. But definitely something to consider for all first responders.
Yes, ma'am. Thank you very much. We're definitely exposed to it quite a bit nowadays.
Unfortunately, yes. I hope everyone is taking the safeguards that they
Yes, ma'am.
can for these benefits. But of course, if you do, I'm happy to assist.
Thank you, Miss Anna. Is that all you have for us today?
That's all I have. Please let me know if there are any questions about any of the benefits. Answer.
Thank you, ma'am. Any of the board members have any questions for Miss Anna? All right. I'll make a motion to accept the Anna Parrish. I guess, is there any other speakers on her behalf, or is that it? Okay.
That's it.
Yeah.
Motion to accept her report.
Third. All right. All in favor, say aye.
Aye.
Next item is the quarterly expenditure. Does everybody have a copy of that? Any questions from anybody on the board about the quarterly expenditure report?
Second.
Third, all in favor, say aye.
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 Okay, moving on to any public comments from any,
I don't know if you've been aware that I have two things to address, and that's the fact that we got the state money in from for the firefighters' pension, and the estimate from the actuary and from the state was $62,950. The actual amount that came in was $49,571, which was 13,000, almost 400 less than expected. The city has to make up that money because there has to be a certain amount of money deposited. And so the city is making up that $13,000.
was there an explanation as to why there was such a gap?
There
or-
is not. The
Okay.
state doesn't explain it. It's simply what they collect from the taxes that they put on the insurance agents when they write policies. When
Yes,
they
ma'am.
write a policy, there's a tax form that they have to fill out for the state. Depending on where they write the policy, what jurisdiction, the money goes to the fire from that. The other thing I wanted to address is that there is a police and fire conference, November 3rd through the 5th. If you're interested in going, please let me know, because the pension board does have money for the route. The registration is free. It's the hotel
Yes, ma'am.
and the mileage and things like that. But please let me know. I'll make the reservations and everything for you.
Where are they doing that?
Orlando.
Orlando.
And that's it.
All right, that is
I'm
it.
gonna just go find out if there's been any comment, public comment.
Okay.
I'll be right back.
Standing by for further comment this time.
There is no public comment.
Okay, no further public comment at this time. Is there any other business that would like to be discussed today from anyone? Motion to adjourn by Mr. Linity,
Second?
third, all in favor, say aye.
Aye.
All right,
Aye.
meeting adjourned.
Hi, guys. Nice to see everybody.
Thank you all. Have a good day.
Thanks, everyone. Be safe.